Hi, it's Charles Kelly, Money Tips. Brace yourself for tax rises in the coming budget next month from Rachel Reeves to fill her enormous black hole. What I'm going to talk about today are what to expect in the November budget, my top five tax hikes that I think will be coming, and what you might be able to do about it, because forewarned is forearmed, as they say. Now, look, we know from the research done by the Institute for Fiscal Studies, the various media outlets, that there is a big black hole to fill. The government has boxed itself into a corner. They can't cut spending on things like welfare, which is, you've got thousands of people every day signing on to sickness benefits. You've got 6 million people claiming benefits a year. There's enormous spending on defence, and then there's the debt interest, which is just incredible. I think it's something like 12% of the national spend from taxes go on just paying the national debt interest. So it's a really difficult situation for any chancellor, but that hasn't stopped her spending. She spent something like 70 billion since coming to power. She's borrowed enormous amounts of money, and it's now all coming home to roost. So last year at the budget, she promised that there wouldn't be any more tax rises. This is it for 5 years, she said. Now she's hinting that there will need to be tax rises because of the black hole caused by the Tories. Or now it's the latest one is because of Brexit, the Brexit effect. Yes, she's blaming everybody except herself. And it's now the Brexit effect. Well, yeah, she's saying that the country has lost money since Brexit, and therefore she's got to put up taxes. Well, if that was the case, then that should have been the same for the last government and the previous budgets that they had, and they did put up taxes. There's no doubt that taxes were fairly high, but she's going to ramp them up even more. So she has promised. The manifesto said they would not increase income tax, national insurance, or VAT, which is 20%. It's a lot. So she's finally hinted that taxes on wealthy, the people with the broadest shoulders, as they say, the people with the broadest shoulders should pay the most. But in fact, they do. The people with the broadest shoulders, the top 1%, pay something like 28% of the whole tax take. The top 10% of earners in this country, this is in income tax, right, by the way, they pay 60% of the income tax in the country. So the people with the broadest shoulders are paying the most, and the people with the broadest shoulders can generally say, I've had enough of this, I'm off. And that's what they're doing in their droves, as I've written on previous episodes. But look, here are what I consider my top five likely tax increases. And I've got another bonus one for you. If you hang on to the end, I'll give you the bonus tax rise. Well, first of all, is capital gains tax, an increase or removal of the reliefs, the amount you pay before you start, the amount of relief or the amount you don't pay before you start paying capital gains. I think it's already gone down. It used to be over £10,000. I think it's gone down to £3,000. So she might bring in CGT rates closer to income tax levels or abolish any favourable reliefs, especially for high value assets, property, for instance. Another hit on landlords, the easy target. Two is national insurance on rental income. That could be another one of these. Imposing national insurance on rental income received by landlords. That would be another kick in the teeth for landlords, of course. Number three, possible inheritance tax, IHT reforms. This could be removing the nil residence band, narrowing exemptions and taxing agricultural estates more heavily, which has already taxed farmers to the hilt. They've been going mad. And in fact, the one of the ministers, Angela Eagle, was on Farming Today on BBC Radio, and she said there will be no reversal. There's not going to be any U-turn for farmers, and sort of stuck by her guns. So farmers are not happy about this. Obviously, there's not much you can do about inheritance tax apart from make plans now, but you can't change the rate. So if somebody has died, there's not much you can do, but you can make plans for inheritance tax planning. You can certainly do your best to mitigate the tax liability by use of trusts, for instance, transferring assets now. Although it might be a little bit late for November, but you can still make plans, and you should seek advice. I've had guests on here before talking about what you can do to uh, legally avoid taxes like inheritance tax. Number three is the cash ISA allowance. reduced. We talked about this before. We thought it might happen last year. It didn't. This is the allowance currently is £20,000. There is talk that it could be reduced, according to Money Week, to £10,000, or restructure cushions to funnel savings into investments. I thought it could go down as far as £5,000, or certainly saying that, if you want this amount of allowance, you've got to put it into a stocks and shares ISA as opposed to a deposit based, guaranteed deposit based ISA. So there's two, within the ISA, you can put it into, say, a normal ISA account, which you've got guaranteed interest, or certainly the interest is could be fixed, it could be variable, but they're not going to take away the value of your capital. Obviously, you've only got £85,000 protection with each bank for each account, but it's certainly, to all intents and purposes, it's guaranteed. Whereas a stocks and shares ISA, you're putting your money in and it's invested in the stock market, which can go up or down. Now, I think for young people, long term, you're better off with a stocks and shares ISA for long term savings. But for people who might want to protect their savings, they're nearing retirement, that could be a worry. So that's another proposal. So one thing you could do about that, if you haven't put in your maximum ISA allowance for this year, now is the time to do it. And in fact, there's been record amounts going into ISAs because they're worried about this allowance being taken away. And once that allowance is gone, it's probably gone forever. The new governments are not going to change it. But all the money within an ISA is tax free. And no matter how much you draw out, you're not paying tax on the withdrawals as you are with a pension plan. Fifth is council tax surcharges, higher rate bands, possibly tinkering with the whole idea of council tax and changing it, introducing surcharges on high value properties, or adding new bands, G and H, is on the table to raise billions without touching core rates. I've heard some ministers from the Labour side talking about, well, why is it that Buckingham Palace has a higher council tax rate than some properties in Blackpool? I don't know if that's true or not, but it is a property tax in effect, and they'll be talking about property taxes, wealth taxes, hitting people like the retired people who have lots of assets, but they're not necessarily cash rich. They could be asset rich, but they're not necessarily cash rich. So what this means with these tax changes could reshape property investment, retirement planning, asset strategies. If you're a landlord, investor, homeowner, like millions of people are, now's the time to review your capital gains exposure, inheritance planning, and ISAs. Now, the one I was also, my bonus suggestion here is number 6, is that the government could start tinkering with pension allowances. And again, we talked about this last year. In particular, the tax-free cash allowance from pensions. So when people were sold these pensions, they said, you put your money in and 25% of that you'll be allowed to take out tax-free. I said this myself as a financial advisor, and 25% you can take out tax-free, and they could just take that away and just pull the rug from under your feet, because you've got this pension pot, let's say it's £100,000, 25% is tax-free. You can take that out and do what you like with it, put it into an ISA. I think a lot of people have been putting it into ISAs recently. But the rest, as you draw that money out, you're paying tax on it. So the crucial difference here with pensions, you're paying tax on the withdrawals. ISAs, you don't. But with a pension, you get tax relief on the money you put in. Now, that's another thing they could start tinkering with. And I think that could be disastrous. We already remember Gordon Brown tinkered with pensions and took billions out of pensions by taxing the fund. And that, it's just like a money grab, really, on people who are trying to save, trying to row their own boat and provide for their own retirement, rather than people who say, well, the government will look after me. So let's have a quick look on, maybe we can share something with you here on this to give you a bit more insight, and maybe you can do a bit of your own research. Okay, this is Rachel Reeves, in case you don't know what she looks like. They call her, she's supposed to be with the Bank of England, supposed to be an economist, but really she did a minor job in the Bank of England. Now her nickname is Rachel from accounts. I think she's totally and utterly out of her depth. She doesn't know what she's doing. She's probably relying on civil servants to tell her what to do. I really think, I'm sure she's a nice lady and she's quite smart, but I think this is not the job for her. So you know, before the general election, as they say here on the BBC, she promised not to increase income tax, national insurance, and VAT. But the IFS, the Institute for Fiscal Studies, says she will almost certainly have to raise taxes to make up a £22 billion shortfall in the government's finances. So that's their black hole, not the previous government's black hole that they made up. So the budget comes up on the 26th of November, so we'll all be watching that. And do take note of that. So there you go. They're already talking about it. They're laying. They drop out these little hints and leaks. Oh, we're going to have to do something with things have changed. Typical government, really. I'm talking about all governments now. They make promises and then later on break them. A bit like an estate agent who comes in and says, "We can get 1 million for your house," knowing that they can't, but they want to get the instruction. They want to get your vote, and then later on coming back to you and saying, "Oh well, the market's changed a bit. Perhaps you might want to consider reducing it to £900,000 or £800,000," because they know they've got you on the hook then. And the Labour government have got us on the hook. They've got a majority. They're in for the next few years. No one's going to remove them. So whatever they do, that doesn't really matter. They've got you on the hook. So this is some of the uh, research from the IFS here. This is the forecast for the composition of UK tax revenue. You can see this most of it comes from income tax here, national insurance, which is really another form of income tax. So you can see half of it comes from income tax and national insurance, right? So this is what they've already increased the national insurance for employers, which is affecting jobs. We've got unemployment rates going up through the roof. So look at that. It's nearly half of it is from us. So we go out to work, we pay, sometimes up to, a lot of people are paying over 40% income tax rate, which used to be a higher rate taxpayer for higher earnings, but you've got a lot of nurses paying 40% now. And because they've kept the thresholds frozen, so they haven't been increasing the thresholds before you reach those high levels of tax. But then they're paying national insurance on top. So you say, "Oh, I pay tax at 40%," but really it's 50%. Or you say it's 23%, but really it's 33%. And if you add it all up, half of our income is going in taxes one way or another, whether it's VAT, which you said here, that raises 200 billion. So you've got like 600 billion over here, 200, 800 billion. And what do they do with this money? That's the problem. We don't see the return on this money. We drive around, the streets are falling apart. Things, there's not enough police on the street. They keep making cuts for this, that, and the other. So where is this money going? That's a good question. Corporation tax here. Now that's going to be affected as companies reduce investment. Some of them are moving abroad. I think that this is where they need the growth. They need the growth so that corporation tax goes up, or they get more in corporation tax, and then people have more money in their pocket. They pay more income tax and national insurance, and then they spend more, which brings in more VAT. So it's all these different ways, and this is only part of it. There's loads of other taxes, indirect taxes here. We see 109 billion. Capital taxes 45 billion. So not so much there. Capital gains taxes, but look, property taxes 127 billion. They're taken out of us on property taxes. So that's my summary there. I think you've got to make your own judgment, and see what you want to do. Talk to your financial advisor, and in the next episode, I'll be talking about investing in gold and silver. Now, I'm not giving anybody investing advice, but I want to talk about in the next episode things like gold and silver, which is often neglected and not really talked about. Certainly, financial advisors don't talk about it because it's not in their list of things and funds they can sell you. They'll put your money into equities and bonds. So, yeah, that's it really. If you've got any questions, put it in the comments. Love to hear from you. Don't forget to like and share and support this channel. And I will talk to you again soon. Bye for now.